Hi there. Welcome to Trading Day. I'm Lindsay Biscaya. Let's get to some of the stories we're following for you now in the BNN Bloomberg newsroom. The U.S. is trying to bolster the ceasefire with Iran. It says there would be no more attacks by Israel if Iran stopped its missile strikes. Tehran has since halted strikes, and Israel has agreed to halt attacks for now. Both countries traded attacks on the weekend for the first time since April. Meanwhile, OPEC Plus will increase its output target next month for the fourth time since the closure of the Strait of Hormuz. The federal government will provide loans to domestic airlines facing significant pressures from high jet fuel costs. Airlines can receive up to $150 million in repayable support. That move comes after Ottawa already removed the federal fuel excise tax from April 20th to September 7th. And shares of Eli Lilly are trading higher today after the pharmaceutical company showcased data for its next-generation obesity shot. The drug can help patients lose 30% of their body weight over roughly 2 years. Lilly also says, looking ahead, it aims to move from a one-size-fits-all approach. The data comes as other companies are looking to challenge Eli Lilly and other leaders by offering treatments with benefits beyond weight loss. And we're watching the TSX today. It's rebounding after the kind of sell-off we saw on Friday. The TSX up by 0.3%, really led today by infotech and materials, which are driving the TSX up. Similar story for U.S. markets. We're seeing these in the green today. It seems to be that chip stocks are set for the best day in a year today after that sell-off on Friday. So the NASDAQ up by more than a full percentage point. S&P 500 up by 0.5%. We'll keep watching that for you, too. Meanwhile, though, Friday's market pullback has reignited concerns about just how dependent this bull market has become on a handful of AI-related stocks. So joining us now to discuss is Kim Iskian, Director of Marketing and Research at Tuttle Capital Management. It's great to have you join us. Thanks so much.
Super. Thanks for having me, Lindsay.
So as we're seeing chip stocks really rebounding today after the sell-off on Friday, what do you make of the direction of the markets we've seen over the last couple of days, particularly today?
Well, I mean, anytime you have such a severe correction as we saw on Friday, there's going to be a bounce back. And that was partly profit taking from some of the names that have moved the most. And that was, of course, also a function of interest rate fears. And it wouldn't surprise me if we see a lot of choppiness in coming days, just as those issues, as well as the price of oil and, of course, the Iran war are all overhangs in the market.
Right, because was the pullback we saw on Friday like more of a healthy correction or a warning sign that markets have become too dependent on a small group of AI names?
Well, I think it was a bit of both. And I mean, when you look at the concentration in the market, it is at extreme levels. When you look at kind of the speculative froth, you look at the put-call ratio, there is just so much speculation. And the thing is, a lot of it may well be justified just because AI is growing so fast, and we see a lot of it's not all built on air like we saw in 1999 and 2000, the dot-com boom. But by the same token, whenever markets go up so quickly, so fast, and so much, you're going to see periodic mini corrections or maybe even sharper corrections like we saw on Friday.
How problematic could that be, though, right? Like if investor sentiment toward AI started to cool, how vulnerable would that leave the broader markets?
Well, I think it would leave the broader market fairly vulnerable. But I think what would happen is that you would see a lot of rotation. And there are a lot of statistics out there about how a lot of, actually the vast majority of shares are not hitting all-time highs before Friday. And in fact, the market has been led by a small number of stocks. So I think rather than just all stocks falling, it might be a case more of profit taking and shifting into some of the less appreciated sectors of the market that have been ignored for a while.
What sectors are those, do you think?
Well, I think that one trade that's really evolving, and we actually recently launched an ETF for this, is the heavy asset low obsolescence trade. And that's looking at those sectors, those companies that cannot be replaced by AI, that you can't vibe code on Claude Cowork to replace. So say mining companies and railway companies and power grids and old-fashioned brick and mortar retailers. These are the sorts of kind of unsexy, dull companies and sectors that have been largely ignored by investors for a while. And they're not going away. And they are part of the essence of all economies. And they certainly, I mean, these are shares that probably will stand to benefit over time as investors look beyond the AI trade. So that's really what I think a lot of investors will be focusing on coming weeks and months.
Interesting. I want to bring the ongoing conflict in Iran and the Middle East into this conversation, because I wonder, how concerned do you think investors should be about the fact that this conflict is still very much ongoing, especially given the impact it's had on oil prices and inflation?
I think it's interesting how markets seem to have priced in a resolution of the conflict already. And it's been that way for a few weeks. It's kind of unusual to see markets hitting highs in the midst of a war and in the midst of energy prices still moving up. So I think there is some scope for a greater concern as if the conflict does drag on and investors say, wait a second, the assumption has been that this will all go away fairly quickly, but what if it doesn't? And what if oil prices remain elevated and it's not all handled? So I think there is that is an overhang for markets. Very much so.
Because what is the biggest risk, right? Like, if inflation proves stickier than expected, what is the biggest risk to markets?
Well, inflation, I think we learned a few years ago when inflation rose post-COVID, and markets really did experience a genuine correction and bear market. I think that's the risk, because inflation is bad across all economies. It's across the global economy. And that would be, in my mind, that's probably one of the bigger risks facing markets.
You've argued traditional diversification strategies may no longer be enough. I'm wondering why you think that, and what does effective diversification look like for you today? Is it, like you said earlier, kind of looking at those companies that don't rely on AI?
Well, Lindsay, I think when you look at the way bonds have performed in bear markets for stocks, most recently in 2022, it's been awful. So a lot of the old saw for, I don't know, 60 years from Wall Street has been, you diversify with bonds. And in 2022, that would have murdered your portfolio because bonds were down by over 20%. And they're no longer a safe haven, and certainly in a rising inflation environment, they're a terrible place to be. So at this point, actual real diversification, there are a few elements to it. One is the sort of halo trade that we just discussed. Another is looking at gold and Bitcoin as both as portfolio insurance, as well as assets that you go to when everything else is falling apart. That works sometimes. And it is position sizing. It's so easy to say, well, I'm up X 100% on my semiconductor positions. Why don't I just let it ride a little bit longer? And that sort of greed is really what can haunt investors when markets take an abrupt turn for the worse. So we talk all the time, Tuttle Capital Management, as well as Tuttle Wealth Partners, about smart position sizing and having a good balance of hedges and thematic trades, but keeping your eye on your overall levels of exposure to those most volatile stocks.
Lots to go over there. We'll leave it there. Kim Iskian, Director of Marketing and Research at Tuttle Capital Management. Appreciate your time. Thanks for joining us.
Thank you, Lindsay.
Canada is making a multi-billion-dollar bet on artificial intelligence. So we'll break down what that means for innovation and Canada's competitiveness after the break. Stay with us. Canada helped pioneer the AI revolution, but many argue it's failed to build the computing infrastructure needed to keep its talent and companies at home. The federal government is now trying to change that with its new sovereign AI compute strategy, featuring up to $2 billion in investments for data centers, supercomputers, and AI access programs. Joining us now to discuss is Sami Kabria, CEO and co-founder of FlexGrid.cloud. Hi, thanks for joining us.
Hi, it's a pleasure. It's a privilege to be here. Thank you for the invite. Appreciate it.
Of course. So lots to go over here. Obviously, this is off the federal government's announcement last week when it comes to their new AI strategy. Canada has long been known for its AI research talent. Is that right? So why has it struggled to build the actual infrastructure side of things?
I don't think it's actually a struggle. I think we actually have everything in place. It's really tied to how do we look at the vision of what Canada wants to do from a sovereignty perspective, from a capability and capacity view. It's all here. I can actually vouch for that. Like, I am a Canadian. I graduated from the University of Manitoba decades ago, and I live in the US, and I'm bringing it back to Canada because Canada already has everything. It has everything, and it just needs that policy in place to show that it's a country that wants to lead in that space. And it's doing that. And now it's amazing to see.
Okay, so it's really the policy that was missing, and now the government's trying
Yes.
to get on top of that. It's framing this as a sovereign AI strategy. What does sovereign AI actually mean?
Sovereign is not only about like a geographic placement, it's actually about control. So if you're building something, you may not have all the components in place to build it because there's obviously manufacturing and deployment in different ways and different scales. But once you build it and you own it, so after you purchase it, you want to be able to control that. So no matter who the individuals or the companies are, you want to make sure that that strategy encompasses the control of it. Now, there's the physical side of it that we can see when things are being built. There's also the other layers that actually go into the AI strategy itself. Everybody talks about models and, hey, what is intelligence? So not only does Canada have to own and manage the physical infrastructure, they may not build everything, but they have to own it and manage based on the geographical context. But they should also, which they have the skill set for, around where and how you deploy your frontier or foundational models that the country owns. And I can tell you across the board that any Canadian that graduates from any of the amazing institutes on the AI side gets hired really quickly, very fast by any country in the world.
So then, correct me if I'm wrong, that has been a fair concern in the past, right? Like, one criticism is that Canada has funded infrastructure that sits on Canadian soil, but it's actually controlled by foreign companies. Is that something that's still a concern for Canada? And if so, how do we go about fixing that?
I think this policy is actually showing how we can fix it, right? So we actually bid on an ISED project with TMU, where we're building something that Canada can actually own and operate at the same time, right? So the operations can't be tied to offshore. It's got to be the growth of it internally as well. And so countries or companies have to be able to offload that operations to the sovereign nation, which is what we're seeing through the policy of it.
The government also investing $1 billion in public supercomputing capacity. Can you maybe explain further exactly what that means and how important compute access is for researchers and startups as well?
Yeah, so there's two sides of supercomputing. The first is like everybody talks about training. Hey, I've got these crazy size data centers and I've got these GPUs and I need to go train a model. So I've got this big mathematical input and output that needs to be trained. After you go off and train it, you got to use it somehow. You don't necessarily use the same compute for it. You may want to use it in different ways, or you may have different compute for it where everybody talks about inference. Here's an example. One of our partners comes out of South Korea, and Canada has the capabilities to do this as well. Where we look at the inference side of it, you need to go deploy that so other researchers, other industries, as well as other innovations can come out of that. And so that's something that we're actually deploying internally as well, where we look at how you deploy infrastructure and how you connect all that infrastructure together, even if it's smaller pieces, so it looks like one big massive compute. So supercomputers are really tied to two different things. There's one big centralized view of it, and then there's a distributed view of it as well. And so we're pushing the distributed view of it so that everyone has access and equity as part of it.
It requires a lot of power, though, right? Like, is that going to be a headwind down the road, do you think, for Canada?
Yes, if you're doing massive training, yes. If you're doing inference, no. So like as an example, we've got a board back here from AMD. We've got these GPUs or inference cards that actually run, and we can deploy these, what we call cabinets, locally at like telco sites, or where you see the little telco operator sites. The reason that's that are really, really good deployment models is because there's power, there's infrastructure, there's reliability and resilience to it. And then if you deploy these compute nodes in those areas, you can actually build that that's already there. There is enough power and fabric in those places for these types of initiatives.
Got it. I love that you have the show and tell, because sometimes it's hard to know exactly what all this stuff that we're talking about actually physically looks like, right?
Definitely. Like we're in
ahead.
it day in and day out. So like if you can't build it, if you can't touch it, it's hard, right? Everybody talks about like compute, but what the heck is a computer? And now they're throwing the crazy world around tokens. Like, what does that even mean? It's very challenging. And so like we definitely, having these conversations can definitely help with that.
Yeah, it's hard to know sometimes what everything actually means. When it comes to Canada's approach compared to what we're seeing in like the US, Europe, the Middle East, how do they compare, do you think?
If you would have asked me this actually like a year ago, I would have said they're a little bit behind. When we're looking at the initiatives today, they're on par with what we're seeing actually globally. We've got deployments that we're talking through actually in the Middle East today, where it's very much aligned to how you actually build a sovereign solution, where sovereignty is, yes, they know that they don't own everything, like they don't manufacture everything in-house, or they don't have the chips in-house. How do you get it so that they own and operate? So as of today, now what I see with the Canadian perspective is Canada's actually very much a front leader. And they're a front leader because they do two different things, actually. So number one is we've already invested in Canada. Our power supplies that we actually have that comes in for our little nodes are actually manufactured in Toronto. We have an amazing network in Canada, and Canada should actually see that and be very proud of that. I know I am, as a Canadian living in the US. And so I think that's like they actually have, Canada has a leg up across many, many countries that we see, that we speak to today.
Interesting. Okay, Sam Gabriev, CEO and co-founder of FlexGrid.Cloud. Really great to have you. Thanks so much for joining us.
Pleasure. Thank you. Appreciate it.
Coming up, major OPEC members have agreed to a symbolic increase in their oil output for July. We've got more on that when we come back. Stay with us. At their meeting on Sunday, major OPEC members agreed to a symbolic increase in their oil output for July. The move is symbolic because the closure of the Strait of Hormuz will prevent them from actually increasing exports from the Middle East. For more, we were joined earlier by Rebecca Babin, senior energy trader and managing director at CIBC Private Wealth.
The purpose of having the meeting and the increase is twofold. One is to kind of give the market a signal that OPEC, after the departure, very high-profile departure of the UAE, is still a functioning group that continues to monitor the market, make changes, and kind of stay cohesive. It's more of a signal that this is not a group that's falling apart, but one that will continue to play an active role in market management. Two, I think the increases, although, at this point, as you mentioned, not going to translate into market barrels on the market, does give the market the indication, like when things do resume, which we cannot stay this way indefinitely, there will be increases in production coming from OPEC nations. Now, I would assume the market right now is looking through these numbers and saying, well, when things do resume, almost everyone who can will be pumping significantly higher than quota initially, at least to recover some of the lost supply if they can. The key is who can. And I think that's the key when you look at OPEC. When you have UAE having left, it's really Saudi Arabia with the spare capacity. Their quota right now is around 9 million barrels. They have 12 million barrels of potential spare capacity. So they could ramp should they choose to. So I think there's a lot going on behind the kind of symbolism of the meeting to give the market the right indication of what their plan is. They do not plan to just ramp, indiscriminately as the market might guess. They're going to be measured about it, and to give the market the indication that they are still very much a functioning group.
It's 188,000 barrels a day in terms of that increase. How significant is that?
It's not. We're looking at a supply loss of between 10 and 12 million barrels a day from the Strait of Hormuz being, effectively closed. So that is really not a number that is going to matter. Again, the spare capacity numbers are what matter. Saudi Arabia could bring back additional 2 million barrels a day. With the UAE kind of off and no longer under a quota system, market is expecting that they bring back 500,000 to 1 million barrels of their spare capacity above what they were producing at prior to the conflict fairly quickly. And I think that's a really key point here is the market is looking through this event to what happens next. When Hormuz is open, how much of a supply increase can we expect from OPEC nations? Okay, it's not huge from anybody outside of UAE and Saudi Arabia, but those are meaningful barrels. It could be 4.5 million barrels of additional supply to what we had pre-conflict. And I think that's part of the reason when you look out on the curve, you don't see as much of a reaction as maybe the market would have expected. It might be overplaying its hand in terms of estimating that supply coming back and underestimating how much excess demand might be out there to refill these inventories. But that's what the market is focused on at the moment.
So how will this work then? Like if the Strait of Hormuz does reopen, let's say hypothetically next week, when things resume, that I know you're laughing, but when things resume, will that increase that OPEC has announced actually automatically kick in, even though it's just symbolic right now?
So theoretically, yes, right? They would be able to go to those quota levels, but what we really need to keep in perspective here is that that's going to be a road that takes several months for some of these countries. Like if we look at Iraq, they've had to shut in a tremendous amount of production. They may have damage to their fields at this point. Same with Kuwait. In some of the energy oil ministers, have been talking about several months to get this up and kind of back to the point where these levels of production will even be relevant as part of the conversation. But again, we're talking about months, not years. So is it 3 months? Is it 6 months? Hard to gauge. We don't know how much damage has been done, but Saudi Arabia likely can bring back production very quickly. And they're the biggest producer with the most spare capacity. So that's the one to watch. UAE also can probably get things up and running once the strait opens in weeks, not months. It's the kind of smaller tertiary countries that will have a harder time getting there.
Got it. Okay. In the meantime, though, how does the latest Israel-Iran exchange shift your base case for escalation? And what would it take for markets to finally price a non-diplomatic outcome to all of this?
It's a great question. So I think as you can see from the market reaction this morning, we were up 4% in crude overnight. We're back down to around 1%, 1.5% at the moment. What's happened over the weekend doesn't really shift the base case for myself or as you can see from market participants. And, it's hard to kind of wrap your head around that, but we've kind of had these moving goalposts of where the red lines are. And the rhetoric that we've seen following these events kind of indicates that no red lines have been crossed from either side at this point to change the conviction that we're on a diplomatic path. Now, what changes that? I think two things. One thing that's been mentioned by President Trump is that if a U.S. Military personnel is killed, that would be a red line. I think the second red line that would really incite other Gulf Coast nations is if the Houthis, which did threaten to become more involved in this conflict over the weekend, actually do start targeting ships in the Red Sea. That's been a key kind of release valve for where flows have been rerouted. And if that starts to become more constrained, we will see a market reaction. And I think that's a red line for other Middle Eastern countries. So those are kind of the two things that I'm looking at for what changes the base case of a diplomatic outcome. But for now, it seems that at least the U.S. is very, very convicted and dedicated to achieving a diplomatic outcome. It just is yet to be determined if it actually works out or how long it takes. And I think the how long it takes is the critical question.
That was Rebecca Babin, senior energy trader and managing director at CIBC Private Wealth. Up next, shares of Apple are higher today as investors await key announcements and updates from the iPhone maker's Worldwide Developers Conference. We're back in a moment with that. The U.S. is trying to bolster the ceasefire with Iran. It says there would be no more attacks by Israel if Iran stopped its missile strikes. Tehran has since halted strikes, and Israel has agreed to halt attacks for now. Both countries traded attacks on the weekend for the first time since April. Shares of Corning are up today after Amazon announced a deal worth billions of dollars for optical fiber to power and connect its U.S. data centers. It will create 1,000 jobs at Corning's North Carolina factories. The glass company's fiber optic cable and networking solutions are becoming essential elements of AI infrastructure as they enable fast connections between data centers and the racks and chips in-house. FTX co-founder Sam Bankman-Fried has formally applied for a U.S. presidential pardon. This comes more than 2 years after he was convicted of fraud worth $10 billion U.S. and sentenced to 25 years in prison. Bankman-Fried is also awaiting a decision from New York's federal appeals court that's considering his bid to have his conviction and sentence thrown out. And we're watching the TSX today. It is rebounding. It was earlier today. It still is after a sharp sell-off on Friday. Similar story for U.S. markets as well. We're seeing chip stocks rallying again today, which is pushing U.S. markets higher after a sell-off once again on chip stocks on Friday, as well as in the materials sector and a few other indexes. But you can see the S&P 500 up again today. The NASDAQ up more than a full percentage point. Apple's Worldwide Developers Conference has kicked off as investors closely scrutinize any progress the company has to show in their artificial intelligence business. Let's get more now from Tom Forte, Managing Director and Senior Consumer Internet Analyst at Maxim Group. It's great to have you join us. Thanks so much.
Thanks for having me on.
So the conference kicked off not too long ago. I guess I'll start by just asking you, is there any updates so far in terms of what you've heard at this conference?
Yeah, so right now they're going through the changes they're making to Apple Intelligence. I think this is probably the most important thing we're going to learn today, how they're going to use Google's Gemini to enhance Siri. I still remain very skeptical on the ability to materially improve Siri, but I would say so far what I've seen, this is the most interesting part of the keynote yet.
I want to talk about your skepticism in just a moment, but I also want to ask you, I'm sure this was the biggest question facing Apple today at this conference, right?
Yes. The other thing, though, that's been a bit disappointing so far is that I've been looking for John Ternus, the CEO who's replacing Tim Cook effective September 1st, to make an appearance. And so far in the keynote, he has not. He did, as you remember, make some brief comments in their last earnings call. Because what I'm trying to determine is he's a hardware engineer, and will he materially change the software strategy for Apple as it pertains to artificial intelligence? Will this reliance on Google be a short-term fix or a long-term fix? So that's something I'm still monitoring.
I know you wanted to get a clearer picture on that, but how do you think John Ternus, like before you've heard from him, because I know you said you wanted to see him at this conference, how do you think he will kind of change the company with that background that he's bringing with him?
Excellent. So the way that I think about it is this. Naming him as Tim's replacement is a reminder that Apple views itself as a hardware-first company. I think there's some low-hanging fruit ahead of him as far as having new Apple products that are based on successful other consumer electronic products. Think what Meta's done with the smart glasses and what Samsung and others have done with foldable smartphones. So I think that his product roadmap likely includes those things. And then the question is ultimately, how much can he channel his inner Steve Jobs, assuming he has an inner Steve Jobs, and come up with a consumer electronics product that consumers don't know they want today, but will buy in the future. And that certainly remains to be seen.
Okay, I want to get back to the big topic of discussion, which is the AI overhaul for Apple. You said you're a skeptic still about this new plan that Apple's announcing today. What are you so skeptical about?
So if you look at Alexa for Amazon and Siri for Apple, they certainly had a pole position. They were well ahead of the curve when they rolled out those two digital voice assistants. Since then, you've had the emergence of OpenAI, Anthropic's Claude, and others. And part of the reason you've had the emergence is that Amazon with Alexa and Apple with Siri really weren't able to capture, I call it that first mover advantage. So now I think the good news is that they're relying on Google and Gemini to materially improve the AI enhancements for Siri. But based on my longstanding experience with Siri and more recently experience with Gemini, I think there's still a lot of room for improvement, be it either hallucinations or I have seen them talk in the keynote about improving the dictation for texts, things of that nature. I would say that Siri still can get a lot better in that regard.
What does that say, though, about Apple's AI capabilities if it is still relying on Google?
Yes. So the way that investors are thinking about it is Apple essentially giving Google the keys to the kingdom by relying on Google for Apple's AI efforts? And I would say that the good news today is that consumers are still heavily engaged with Apple devices. The double-digit growth they've had in iPhones the last 2 quarters, and it's still more than half their revenue, is incredibly important and impressive. The question and the challenge for Apple will be in the future, will consumers continue to use their hardware to engage with AI? And I would say that remains to be seen, but it's clear that in 2026 today, that's still happening.
Right, because as you say, Apple's got a huge market share already. Does it really need to win in AI if it can rely on Gemini and other large language models?
And the question or the answer to that will be, how important will AI be from a consumer engagement standpoint? And I would say that in order for AI to be more, call it consumer friendly, they're going to have to get over the hallucinations. And I think you're also seeing some increasing consumer pushback, both in the not in my backyard element, where consumers don't want the data centers built in their backyards because they're concerned about either water consumption or it's going to raise their electricity bill. And then you're also seeing consumers opt for search providers that are much less reliant on artificial intelligence. So I do think you are seeing a bit of a consumer backlash to artificial intelligence, which, contrary to what you might think, would actually work in Apple's favor because they're not as far along in capitalizing on AI.
And we know Apple's stock price as well and PE ratio, they are near record highs. Do you think the market has shifted focus away from Apple's AI strategy?
I think that the working with Google has de-risked it, at least on a near-term basis, as reflected in that record high share price. But I also think, going back to my comments earlier in the iPhone, when give or take half your revenue is coming from the iPhone and it's growing at a 10+% rate 2 quarters in a row, suggests that consumers have tremendous demand for the product, even if it isn't cutting edge from an AI standpoint.
And just lastly, very, very quickly, you still have a buy rating on the stock. Would you consider revising that?
So what it would take right now for me to revise my rating would be either the stock to trade materially higher than it is right now on today's fundamentals, or someone other than Apple to come out with a consumer electronics device that so captures AI that it materially negatively impacts Apple, which right now I'm skeptical we'll ever see that, but certainly aren't seeing that right now.
Okay, Tom Forte, Managing Director and Senior Consumer Internet Analyst at Maxim Group. Really appreciate your time. Thank you.
Thank you, my pleasure.
Coming up next is Hot Picks. We will zero in on 3 picks in real estate right after the break. Stay with us. It's time now for Hot Picks, and today we are zeroing in on the real estate sector. We were joined earlier by Ji Zhang, Portfolio Manager of Global Real Estate at Cohen & Steers, and kick things off with her thoughts on what's been driving the growth for the overall sector in the past year.
With the Fed starting to, be quite range-bound in terms of the rate expectations, and with greater volatility in the broader environment, real estate has really been a very good safe haven, and investors who have come into the year under-allocated real estate have been adding to their real estate exposure.
Do you think we're seeing a turning point, particularly for commercial real estate?
I do, and we're seeing that both in office and retail. So Boston Properties is one of those companies where we're seeing that resurgence and that recovery in fundamentals. So this is a really interesting case where the market narrative and the reality just aren't lining up. It's a $9 billion company owning a portfolio of high-quality office buildings. And despite the name, it's not just Boston. You've got New York at 25%, San Francisco 15%, DC 15%, and smaller exposures to LA and Seattle. And while Boston is a bit softer, when you're looking at what's actually happening in New York and San Francisco, these markets are performing much better than people realize. Of course, there's this big narrative that AI is going to reduce jobs and kill office demand. And that's been really weighing on these stocks. But at the same time, when you look at what's on the ground, we're seeing something quite different. What we're seeing is innovation. We're seeing job growth. And we're seeing that translating into demand for office space, and that's leading to strong leasing activity. And in New York in particular, that tight availability for office space is pushing rents higher. So what you've got is a public market that is still pricing in a very negative narrative. And at the same time, you're seeing fundamentals that are materially better. And that's where we see the opportunity.
Okay, yeah. So Boston Properties, your first hot pick for today. I wonder, is there a growing difference between high quality, like trophy office space compared to older office assets?
You're absolutely right. And we've been seeing that for a few years now, because when you think about employees that are trying to bring their employers that are trying to bring their employees back to the office, what they're really focused on are those well amenitized buildings, good locations that attract a place for employees, that offer a place for employees to collaborate. And that is really important. So we have seen a clear have and have not within the office sector, where you're seeing strong pricing power, you're seeing strong occupancy in the best portfolios. And even the lower quality assets are starting to get better because that supply is coming off. You're seeing a lot of office to resi conversions. We haven't seen office supply. So because San Francisco and New York, these markets are getting quite tight, we're actually seeing a broadening out of trophy to A assets in locations that we haven't seen in many years.
Interesting. Okay, so next up is Blackstone Digital Infrastructure Trust. How does this play into the AI investment theme?
So this is a really interesting one, because when people talk about AI infrastructure, most of the focus is on who is building data centers. What's much less talked about is who is buying those data centers and owning them once they're built. And that's what makes Blackstone Digital Infrastructure Trust really compelling. So it's the first public vehicle of its kind sponsored by Blackstone, which is already one of the largest data center owners globally. So they know what they're doing. And the strategy is quite differentiated, focusing on acquiring stabilized data centers that are mission critical in primary markets leased to hyperscalers. So the opportunity here is massive. We're looking at roughly $1 trillion of AI-related capex and a data center market that is supporting a multi-$100 billion acquisition pipeline.
It's so interesting.
So BXDC.
Yeah. Continue. Sorry.
Sure. So BXDC, it's essentially sitting in the middle of this ecosystem as a capital provider, funding the build out. And this is a great opportunity.
Sorry, I was just going to say, like, it's interesting when investors usually focus on AI, they look at like chip makers, software companies. Do you think enough people are looking at data center real estate instead?
I do think people are looking at data center real estate. They're also looking at utility companies that are supporting and providing the energy for this infrastructure. And what we do think is that the infrastructure layer is providing not only the secular growth drivers to that upside, but also a name like Blackstone Digital Infrastructure Trust also provides that stable and growing income for investors, which is quite compelling.
Your last pick is RioCan. I wonder what's attractive about Canadian real estate today?
So Canadian real estate and RioCan is a great example of how retail real estate has come full circle. And we've seen it here in the US, we've seen it in Canada, we've seen it in Europe. And what we have seen is this real resurgence of retail real estate. So about a decade ago, Cohen and Steers, and of course, our bread and butter is real estate, made the right call that e-commerce was going to massively disrupt brick and mortar retail. And a lot of that disruption has already played out. So what's left today in all of these markets is assets that have become significantly more valuable. And we're seeing a real resurgence in fundamentals that's leading to sustained pricing power and sustained activity. And RioCan, and that's exactly where RioCan is positioned. It's a portfolio of high-quality shopping centers in Canada, as you said, in locations where consumers and retailers actually want to be. And because we haven't materially added retail supply in years, there's real competition now for these locations. And that's pushing rents higher, and that is leading asset values to new highs. And by the way, management, the new CEO, Jonathan Gitlin, has done a fantastic job of cleaning up and simplifying the story and leaning into their core strength, which we think is critical. So in RioCan, when you put it all together, you have strong retail fundamentals, you have the right portfolio and team, and you have a cleaner story. And the stock has actually already reacted well, but we do think there's more upside here.
That was Ji Zhang, portfolio manager of global real estate at Cohen and Steers. Coming up, the price for SpaceX IPO shares is expected to be announced this week. We'll take a closer look right after the break. Stay with us. Elon Musk wants to build the infrastructure for AI in space, and he's asking investors to help pay for it. The rocket satellite and now AI company wants to raise around $75 billion in what could become the largest IPO in history, funding everything from its Starship rocket to AI computing power and future data centers in orbit. Bloomberg's Tech Ed Ludlow takes a look at what's at stake.
Ignition.
Elon Musk wants to build the infrastructure for AI in space, and he's asking investors to help pay for it. The rocket, satellite, and now AI company wants to raise around $75 billion in what will be the largest IPO in history.
SpaceX is probably our greatest, commercial space company, hands down.
It will enable the next iteration of what we want to see as the space industry continues to grow.
This isn't just a space story anymore. After folding in Musk's AI startup xAI earlier this year, investors buying into SpaceX are also buying into the future potential of Grok AI models and Musk's vision for massive computing infrastructure. That ambition comes with a hefty price tag. New filings show SpaceX's AI business, as in xAI, lost nearly $6 billion last year and billions at the start of this year as money poured into computing power and infrastructure to compete with OpenAI and Anthropic. Still, SpaceX has major advantages. Starlink has become a powerful cash generator through its satellite internet business, while the company's launch operations continue to secure billions in government and private contracts.
What people need to realize about this company is it isn't just a little bit ahead of the entire launch industry on planet Earth. It's orders of magnitude ahead.
And now, Wall Street wants in. Goldman Sachs, Morgan Stanley, and JP Morgan leading more than 20 banks working on the offering. And Musk negotiated record low fees. But the IPO also raises big questions like whether investors are comfortable betting not just on Musk's original vision of making humanity a multi-planetary species and getting to Mars, but on a future combining rockets, AI, and social media into one sprawling empire.
And so what we're buying is the next, the global economy, 2.0 and 3.0 as we look at buying into SpaceX.
If that happens, SpaceX could redefine what the modern public company looks like on Earth and in space.
Okay, we'll take one last check on the markets before we wrap up here. The TSX to start, seeing some gains today after losing a lot of ground on Friday, as we've been telling you, up by 0.2%. If we look at some of the big gainers on the TSX today, TerraVest Industries is rising after finishing bottom of the TSX on Friday after a report of alleged insider tipping by its executive chairman. We're also watching Shopify, which is up by more than a full percentage point, but TerraVest up by more than 5%. Birchcliff Energy is another one. It's up by almost 7% right now. This volume has jumped to more than 5 times the average, and call options have doubled today. It's currently at the top of the TSX as well. And we're watching U.S. markets. Intel, well, we'll take a look at U.S. markets. First of all, the S&P 500 is up. The Dow Jones currently down ever so slightly, basically flat at this point. The NASDAQ up by more than a full percentage point. And of course, we're watching Intel. A lot of the big chip stocks today are seeing a rebound. Intel's gaining on reports that Google will rely on it for more than 3 million specialized AI chips in 2028. So more than 12% right now. Micron's up as well, and Applied Digital is up. And that wraps up this edition of Trading Day. Thanks so much for watching.